Why most funds don't beat the market. So here's my friend Mike. He loves indexing and he always tells me that it's impossible to beat the market, and then even big funds cannot beat the market. So I let you in on a little secret. The goal for many funds is not to beat the market, but to get the most assets under management, because that's where they make the most fees. The way most funds make money is through management fees. Don't get me wrong, I don't mean the partnerships that actually make money for their investors. There are plenty of them out there. But most funds just want one thing, and that's fees. I have a big problem with funds that charge 220 and closet index. They're not doing anything for their clients, and the only person that's making money is this guy. Here's a simple math how they make money. Let's say the assets under management are 100 million. They make 2% management fees and 20% performance fees. So let's say they make 10% a year in return. So he earns $2 million from management fees and another $2 million from performance fees. I excluded hurdle rates for simplicity. So he makes $4 million for his fund himself. Great job. Why should he risk his assets under management to make 5% more, which would net him another $1 million? If he fails, he risks losing the assets. That's the worst for him. The best way to keep assets is the closet index. You basically buy the biggest stocks of a popular index, so your performance is always similar to it. Here's the super awesome fund, and here's the SP 500. The fund's managers' incentives are not aligned with the investors. The fund makes money regardless of beating the market, as long as they perform just good enough. Most people are better off with investing in an index fund. If you're interested in investing in a private fund, then you should ask the manager one question: how much of his own money is invested in it? If it is a sizable amount, then it is probably one of the better funds. But if his own money isn't even in it, then why should be yours?